Good evening, guys. Welcome back to PSP Source. In our previous videos, we have seen the meaning of financial management. Okay, now we are going to see the approaches of financial management. So, let's start to see the approaches. Okay, there are two approaches in financial management, that is, traditional approach and modern approach. In traditional approach, first content consists. A traditional approach is also known as outsider looking approach. Why? Because it only focusing to search where the sources of finance is available. It only focus where the sources are available externally. Okay. The second line is it treats the finance in the narrow sense of procurement of funds, which means it only consider where we can get the finance and it completely ignore the where in which utilize such finance. Okay. The third line is it overemphasized long-term financial problem. Thus, ignore the importance of working capital management. Now, what is long-term finance? We can see the long-term finance as financial instruments. A financial instruments means which gives benefits for more than 1 year. Which gives benefits for more than 1 year. For example, bank loan, bonds, leasings. These are the some examples of long-term finance. Okay. Now, what is working capital management? A working capital is the capital. You know very well. A working capital is the capital which meets day-to-day obligations of the business. For example, from purchasing of raw material, paying rents, and paying wages. In that wise, they meet their obligations. So, every company should ensure sufficient balance to meet short term as well as long term obligations. So, every company should ensure sufficient balance to meet short term as well as long term obligation. Okay, but under this traditional approach, it only point out long term finance only. Okay, under the traditional approach, it completely ignored short term, that is working capital management. It only focus long term management. Then let's move on fourth line. It has completely ignored cost of capital and optimum capital structure. Now, what is cost of capital? The cost of capital is the minimum rate of return is expected from the investors. And what is optimum capital structure? Optimum capital structure represents the optimum proportion of debt equity mix. Okay, we can say in every company should consider these two factors very crucially. Okay, but in traditional approach it completely ignore. Okay, next let's see the second approaches of financial management, that is modern approach. Modern approach gives wide scopes than the traditional approach. Modern approach gives more solution for traditional approach. Let's see what are the content under the modern approach. This approach focus wise use on funds, which means which conveys it not only consider availability of sources of finance, it also look to affect utilization of such sources of it. Okay, so move on next line. Under modern approach, it concentrates financial management solution for major areas. Such areas called investment, financial, and dividend areas. Now, what is investment decision? Under investment decision, the company should analyze um, how much of investment need to be invested in long term manner, and how much of investment need to be invest in short term manner. Okay. In the long term investment called fixed asset, we know very well the fixed asset consists land and building, plant and machinery, furniture, and other long term equipments. For short term investment represents current assets such as accounts receivables, investors, cash, inventory, like that. Okay. So finally, hence the company decides how to invest their money in both form. That both form means short term as well as long term. And finally, acquired such assets likewise. Okay. The second decision is financial decision. It talk about which sources of finance gives more benefit to the company. For example, debt equity mix should be optimum for the company. Okay, we can say the optimum capital structure means the proportion of debt equity mix. Okay, the proportion of debt equity mix should maximize the wealth and the market value of the business. So the proportion of debt equity the proportion of debt equity means the debt and equity means the debt called borrowed capital, equity called owner's capital. That combination should be maximize the wealth of the organization and market value of the organization. We can say if we raise more debt capital than equity, if we raise more debt capital than equity, it will leads to give more interest for each year, even if there is a loss occur in business. So companies should keep in mind the risk level of such shares before raised capital. Okay. Finally, the third decision is dividend decision. Now, what is dividend? We know very well what is dividend. Dividend is the portion of profit that distributed to the shareholder. Now, what is dividend decision? Now, what is dividend decision means how much of profit is to be distributed as dividend, and how much of profit is retained itself. Okay, how much of profit is distributed as dividend, and which money is retained itself for expansion of business. For example, if the company distributes its profit fully as dividend, then the company will suffer scarcity of fund. Okay, so dividend decision should be taken by using some techniques, such techniques called dividend policy. Okay, thank you guys.